some salt in the wound here for some people. If I have a strategy that has a high percent profitability and profit factor with a low max drawdown, does that mean my strategy will make me money? No,
I
not
mean,
necessarily.
is the question associated with the idea that this is the back test that you did? You haven't done any kind of walk forward test yet?
That's right. This is all in the backtest scenario, and I put this in here because I get it essentially all the time. In fact, we even see it on the different signal groups and on our server, where people go, "Well, the strategy is good because I have a high percent profitability, high win rate, and a high profit factor. My max drawdown is like 5% or less, and so now I'm going to run this, and I'm going to become super wealthy." And the issue there is what Mike brings up constantly is that the your future data doesn't necessarily, it's not exactly one for one with your back testing. Case in point, the volatility event that we had just this week. There's always things that can happen that changes the distribution of outcomes, and
Absolutely.
you can't guarantee the outcome. And so it gives you a pointer that, hey, maybe you might want to test the strategy, but there's no guarantee that it means you'll be successful.
Yeah, and I think it's also fair to say that like testing window makes a huge difference. I think one of the biggest flaws with backtesting on TradingView is the limited trading window by which you can run tests. Yes, there is the deep backtesting system, and it does go a little bit further back. But the longer you can actually test your strategy, especially if you're doing intraday, which I know many people are, over a longer period of time, the more likely it is that you're going to incorporate some of those strange deviations in market activity and behavior. And if your strategy still stands up over that, then you can gain a lot of confidence, of course, that you've built something that's pretty robust. But a lot of times I think, if people are on lower account tiers with TradingView and they're not using the deep back testing system, they're basically testing on 5,000 bars of data, and that doesn't go back very far. So there are many situations in which you could be testing your strategy in a really low volatile environment, like 2 weeks ago when the VIX was down in 12s, in the 12s, and your strategy looks fantastic. It looks like it stands up really well, and then boom, the Japanese market raises interest rates, and you see volatility like you haven't seen in 12 years, 14 years. That volatility spike was one of the largest we've seen in a while. So I think it's important to realize that robustness comes from the history that you test against, the number of trades you're testing it against, and making sure that you've really covered all the different types of market regimes.
The thing that has now been drilled into me, now it's my mantra, and we see all the time in the trading bot session videos that you do, and that is risk management. Like
Right.
the risk management is the thing that helps prevent you. It's your insurance policy. How is it that you're going to deal with the unexpected, the unknown unknowns, and the known unknowns? If you're not accounting for that, it doesn't matter. You can have a strategy that's running really well for a while, and then one trade can completely blow you out.
Yep.
I find it to be just fascinating. I think I saw someone in the Discord group where they confuse the quantity. They confused some sort of a variable where they thought it was the amount of dollars they were going to be spending, but it was actually the number of shares they were going to be purchasing. And so then it actually sent a signal in a test account. They sent a signal to purchase like $9 million worth of shares. And they're like, "Oh man, I didn't even realize." Well, yeah, because you had a misunderstanding where you initiated this thing, and they're like, "Well, the strategy's fine," but when they actually connected it and they set up the JSON payload, it was the wrong information that was sent. And I see stuff like that, and I go, human error, volatility in the markets is always these points where something can go wrong, and without having that, that's why for me, my risk management is always first the amount of money that's in the account. I can't lose any more than what's inside of that account, so I never put anything more than, if everything went belly up, that okay, I'd still be fine. So I'll have like 5 different accounts just to make sure. And then I used to be so against stop losses or any type of mechanism that would get me out of a trade that would still be profitable. And until I realized, you start to understand, it's the number of trades. It's not the one winning trade that's going to make you everything. It's the series of trades over time. And if your strategy can't abide closing out a winning position, you're still in profit, and fine, you didn't get all the profit you could, but you still got some profit. If your strategy is not like accounting for that over time, that you're making this money over time, then what do you really have? You have a thing where you're waiting for luck, essentially, to be on your side.
Mhm.
And the final thing I'll say is that the amount of times I'll have a client who will show me a strategy, and I'll be like, okay, this is a great strategy, great results that you're seeing instead of backtester. I go, now let me just change the date ranges. I'll go and I'll change the date ranges to something from like 3 years ago, some other random period, and the numbers are terrible. I go, how did you get those numbers? I literally just ran it on a different period, even in the backtest. And they go, oh my god, so it's not a good strategy. No, because you only tested it in an uptrend for in
Right.
this asset and never in a consolidation or a downtrend.
Yeah.
And their mind gets blown.
Yeah, and of course it's frustrating. I mean, like I don't want to underestimate how difficult it is to come up with a winning strategy. It is incredibly difficult, especially on lower time frames. You know, where there's a lot more noise in the market. It's much more difficult to get something that accounts for the massive swings that can take place, the volatility changes that can take place. And it is discouraging to have put together a strategy that seems to be robust and you're very happy with the results, and then you run it on a walk forward test and it falls apart. It just doesn't work, or it doesn't stay profitable in a paper trading account over some number of weeks. You know, we don't ever want to just look at like one trade and say, oh, this doesn't work, I'm walking out of here. We do want to give it the time to actually execute, but I understand how discouraging that is. I've been through that myself, but I think that is where you realize this isn't really a like the mission is to always be seeking new ideas, to constantly try to tweak and refine and get another expression of the market running, and then pair that with the things that you know are currently running, because at some point you know what you have now is no longer going to run anymore, or it won't be as successful as it used to be. Something's going to change about the market that will sort of dissipate some of that performance. So that the journey is constantly looking for great trading ideas, and I think if you get motivated by the idea of constantly coming up with ideas and you're passionate about how to look for those ideas, that's where the whole process can be very rewarding. At least that's the journey I had to take. I think for a while I was like, nah, maybe trading's not for me. And then I was like, but wait, what if I looked at it this way? Wait, what if I looked at this market? Oh, I've never been here before. What about leverage? Oh, okay.
That's right.
Yeah.
Since I think, okay, how once you talked about this a few months ago that where people are they refer to alpha, but it's referring to the wrong thing. Like they
You
mean
mean,
they
yeah,
have
you're just
the
getting
leverage
rewarded
beta.
for additional risk. Yeah, leverage is really just, or I'm sorry, in many cases, what you think is alpha is just leveraged beta. You're just taking increased risk in your returns.
Yeah, and as soon as I accepted, at least for myself, actually from what I've seen, I'm not really seeing anything that's not leverage beta. Like, because it's so hard to beat those types of returns when you actually do succeed. So
Right,
then I
right.
was like, okay, how do I take those leverage bets and still be, as opposed to being like, I mean, I remember sitting on earnings calls and going through reports from the companies and trying to figure out myself, oh, is this a this company undervalued or overvalued, and trying to make bets accordingly. You go, the 90s are over, like that's done. We're in a leverage high beta world,
Yeah,
and that's the game I want to be playing.
I think that's totally true. Anytime I see anything that outperforms the S&P 500, I automatically assume that there's leverage involved in some way.
Yeah.
It's just increasingly difficult to come up with a strategy that can beat the market without leverage.